You pull up to the pump, look at the sign, and the numbers staring back at you are noticeably higher than they were just a few weeks ago. It triggers an immediate sense of unease. Your wallet is draining faster, and it feels like the cost of your entire life has suddenly jumped. This reaction is tied to a specific psychological bias. Our brains naturally fixate on frequent, out-of-pocket transactions, the gas, the bread, the daily bus ticket. When these specific items spike, we remember it. At the same time, we rarely notice the prices that stay flat or fixed bills that auto-draft every month, like rent and insurance. We tend to overlook the fact that while petrol is up, the price of a computer or a holiday may have actually declined. This gap between memory and reality is why consumer surveys often show people feeling an inflation rate much higher than the actual data. We focus on the visible price tags, often missing the comprehensive measurement of the economy. The intrinsic value of the coffee or the gallon of gas isn't actually changing. The resource itself is exactly the same. Instead, the measuring stick you use to buy them is shrinking. This is the definition of inflation: a broad, sustained decrease in a currency's purchasing power over time. It is not a measurement of the goods themselves. It's a measurement of the value of the physical cash you are holding in your hand. When a single unit of currency buys less today than it did yesterday, your existing wealth is actively evaporating. How do economists objectively measure this loss of value across millions of people and products? Central banks rely on tools like the Harmonized Index of Consumer Prices. They construct a representative basket that includes all the goods and services an average household consumes in a year. But a price change in one item doesn't carry the same impact as another. Every product is assigned a weight based exactly on how much of an average household's budget it consumes. For example, coffee makes up roughly 0.4% of average household spending. A sudden price jump here barely moves the currency's overall value. Compare that to petrol, which has a weight of 4.6%. A price jump of the exact same percentage here has 10 times the impact on the broader economy. By tracking the total cost of this weighted basket month over month, economists can determine the official inflation rate for the entire region. This index proves mathematically that your currency is losing its ability to command real-world resources. What specific macroeconomic events trigger these widespread declines in your money's value? A primary catalyst is a significant expansion of the money supply, combined with coordinated fiscal stimulus. When record levels of capital are pumped into the economy, the sheer volume of currency dilutes the value of the money already in circulation. Another catalyst comes from severe supply shocks, like the 1970s oil crises, which restrict the availability of real assets while the money supply remains high. When an increased supply of money chases the same amount of goods, the inevitable result is a repricing. Prices must rise to balance the equation. Whether the trigger is a surge in stimulus or a shortage of energy, the result is the same. Your cash now represents a smaller piece of the total economy. This devaluation is not a one-time event, but an annual compounding rate of decay. Even at a target inflation rate of 2%, the erosion is constant. 2% is shaved off the purchasing power of your savings year after year. Over a single decade, that rate quietly erases over 20% of your currency's total purchasing power. A euro or dollar saved in a bank account today is mathematically certain to buy fewer resources in 10 years. Because fiat currency is designed to lose value over time, holding cash as a long-term strategy is heavily penalized. To protect wealth, capital must move into inflation-sensitive assets. Commodities, real estate, and equities serve as the required mechanism to keep pace with rising prices and preserve a portfolio's real-world value. Because the last period of high inflation ended decades ago, modern investors have short memories, leaving them vulnerable to sudden shifts in asset pricing. Inflation dictates the speed at which your savings lose their grip on real resources. Understanding these weights and catalysts is the baseline requirement for maintaining wealth in the long term.
Do you have any ideas for my next video? Just write them down in the comments below, and I will explain it in the next one. Don't forget to like and subscribe. Thank you so much for watching.